Hi, I'm Jono. This is JPMorgan versus Wells Fargo. Let's compare.
The largest bank in the country has active enforcement orders. The fourth largest just became free of all major enforcement for the first time in 15 years. One was fined $348 million for a decade of failing to monitor trading across 30 venues. The other paid $3.7 billion after employees opened 3.5 million accounts that customers never asked for. One paid $365 million over a relationship with a convicted individual it maintained despite knowing. The other had a 7-year asset cap that suppressed billions in annual revenue. Both were co-defendants in a lawsuit over $870 million in payment fraud, dropped before any mandate took effect. One raised checking fees 25%, the other raised them 50%. $4.4 trillion versus $1.9 trillion. The question is, which bank's failures are more likely to affect you personally? JPMorgan Chase exists because of mergers spanning over a century and 3 crisis acquisitions that doubled its size. The original House of Morgan merged with Chase Manhattan in 2000. A failing investment bank was absorbed in 2008 for $2 a share. The largest bank failure in American history followed months later. Another failing bank was absorbed in 2023. Each acquisition was government facilitated. $4.4 trillion in assets, 60 million households. The chief executive has held the position for over 20 years. In 2020, the Department of Justice filed a criminal deferred prosecution agreement worth $920 million for market manipulation. Traders had placed orders they intended to cancel to move prices in precious metals and treasury markets. The bank admitted the facts were true. That is a corporate admission that market manipulation occurred. The agreement ran 3 years and was dismissed after the conditions were satisfied. In 2023, it paid $365 million in settlements over a relationship it maintained, despite internal documents showing awareness. In 2024, regulators fined it $348 million for a decade of failing to monitor trading activity across 30 venues. The securities regulator found it had used client agreements to prevent people from reporting concerns. $18 million fine. For the consumer, the credit card rewards ecosystem is the strongest among major banks. The digital application is the best of the 4 largest. 5,000 branches, 14,000 machines. The private tier eliminates most fees for clients with 150,000 or more. But an account was frozen for over a month because the verification system could not process a mobile carrier used by tens of millions. A $20,000 deposit was held for over a week. 88% of payment fraud victims received nothing. The checking fee increased 25%. The bank the regulators are still actively monitoring. Wells Fargo was founded in 1852 by the same men who created American Express. The Stagecoach Bank built the American West. In 2008, it acquired a major competitor for roughly $15 billion without government facilitation. Then the cross-sell culture created a scandal that fundamentally changed how regulators treat major banks. Branch employees opened approximately 3.5 million accounts that customers never asked for. The chief executive resigned under congressional pressure. A lifetime banking ban followed. 41 million clawed back. In February 2018, the central bank imposed an asset cap at $1.95 trillion. The first time a bank had been punished by limiting its size. $3.7 billion in settlements. $2 billion returned to 16 million accounts. 13 consent orders closed. $10 billion invested in compliance. In June 2025, the cap was lifted. In March 2026, the enforcement action was terminated. The central bank said the conditions had been fulfilled. For the consumer, roughly 4,700 branches concentrated in the West and Southwest. The cash rewards card at 2% with no annual fee is competitive. The balance transfer card with a 21-month introductory period is the longest from any major bank. No premium travel card competes with the competitor's rewards ecosystem. But in September 2024, a 12-year-old entrepreneur's business accounts were frozen for 15 days over an address flag. A mortgage escrow refund owed since 2021 has not been sent in 4 years. Over 15,000 in mortgage payments were misapplied. The checking fee rose 50%. The scandal is over. The servicing failures are current. But how these 2 banks compare on structure tells you which one's risks apply to your situation. The enforcement records tell opposite stories. One bank has accumulated new fines totaling over $380 million in 2023 and 2024, with active consent orders still in place. The other has not incurred a major new retail consumer fine since the $3.7 billion settlement and just had its last major enforcement order terminated. By March 2026, the bank that committed the larger scandal has a cleaner regulatory position than the bank that never fabricated accounts. Both raised checking fees in the same period, one from 12 to 15, the other from 10 to 15. Both now charge $15 a month for standard checking. Both require minimum balances or direct deposits to waive. Both were co-defendants in the Consumer Protection Bureau's lawsuit over payment fraud losses. The lawsuit was dismissed before any reimbursement mandate. At one bank, 12% of fraud was reimbursed. At the other, roughly 25%. Neither rate protects you. Both banks' customers lost money through the same payment system, and neither faces a court order requiring them to change. Overdraft fees differ slightly. One charges $34 per item with a 50 buffer. The other charges $35 per item with a 10 buffer. Both cap at 3 per day. The account freeze patterns differ in cause but not in consequence. At one bank, a verification system that cannot process mobile carriers used by tens of millions freezes funds indefinitely. At the other, an address classification algorithm flags legitimate business addresses and shuts down accounts with no warning. Both strand customer money through compliance automation that prioritizes the bank's risk over the customer's access. The product gap is clearest in credit cards. One has the strongest integrated rewards program among major banks, with premium, mid-tier, and no-fee options feeding the same points ecosystem. The other has competitive no-fee cashback and balanced transfer cards but no premium tier. For high-spending travelers, the choice is straightforward. For straightforward cashback, the gap narrows significantly. JPMorgan Chase for the customer who values the broadest physical and digital network, the strongest credit card rewards ecosystem, premium banking at $150,000 or more, and the stability of the largest bank in the country, accepting the active enforcement orders, the trade surveillance failures, the $365 million in settlements over a maintained relationship, the $18 million whistleblower impediment fine, the 88% payment fraud non-reimbursement rate, and the 25% checking fee increase. Wells Fargo for the customer who values branch access in the West and Southwest, competitive no-fee cashback and balanced transfer cards, and a bank whose regulatory transformation has been externally validated by every major regulator, accepting the 3.5 million fake accounts history, the documented mortgage servicing errors that continue in 2024 and 2025, the 12-year-old entrepreneur's business funds frozen for 15 days, the 4-year escrow refund still outstanding, the 50% checking fee increase, and the active anti-money laundering agreement. Both charge $15 a month for standard checking. Both failed to reimburse most payment fraud victims. Both strand customer funds through compliance automation. The largest bank has the better products. The fourth largest has the cleaner current regulatory position. Neither will treat you differently than any other account number in a database of 60 million households or 16 million restitution cases. Know the fee waiver conditions. Know the payment fraud policy. Keep an account at a separate institution, regardless of which one you choose. Every choice is a trade-off. At least now you know what you're trading.